Hi, everyone. Thanks for joining. I'm Dan Barabander. I'm the general counsel and investment partner at Variant, a crypto stage VC. I'm joined here today with Paul and James to discuss the future of vaults. So let's have them introduce themselves. Paul, you want to start?
So I'm Paul. I'm co-founder and CEO of Morpho. And at Morpho, we build lending and borrowing infrastructure as well as vault infrastructure. On chain, we have approximately $12 billion of deposits across 20 different chains. And we have a big focus on enterprises and how do we get Morpho integrated to power what we call the DeFi wallet, essentially enabling lending and borrowing for large-scale consumer powered by blockchain rails, right? And as part of that, we have an ecosystem of asset managers / asset curators that run vaults and that power this yield for all those enterprises, right?
Hey everyone, I'm James. I the ecosystem development Ethereum Foundation. What's that mean? Saying from developer growth to enterprise outreach to founder success. All the things that we used to do 6 months ago, we now do an oral CL harvest, but I'm excited to run vaults today.
All right, so this panel is the future of vaults, but in order to do that, I think we need to go through some history first. Because you can't understand the future without understanding the past. So, Paul, can you just walk us through like how we got here, like kind of the iterations and history of vaults on chain?
Sure. So it all started with on-chain asset management being done by the lending protocol itself. So, I'm naturally as our founder was like the Compound and Aave design, where effectively the way people were generating yield initially is you deposit into this like fund that was decentralized in the sense that the management was decentralized, the code upgrades were decentralized. But the problem with this approach was like, hey, if we're thinking big about financing and lending in general, we are going to need to underwrite 7 million people and trillions of dollars of capital every day. And obviously, it's impossible to think that a single entity, even less so a DAO, could underwrite all of this, right? And so the initial inspiration of Vault was like, hey, we're going to unbundle the asset management from the lending infrastructure.
The lending infrastructure is going to be this own permissionless immutable thing on top of which permissionlessly people can come in and manage assets and issue loans. And this way you have much greater, ability to discover new risk, to issue new risk, and adapt to the specific needs of the specific consumers so in terms of adapting the risk profiles, the compliance profile, the liquidity profile to whatever consumer you may want to target. So that was the initial ambition. And so we came up with this idea like a year and a half, 2 years ago, as we were building on top of existing lending and borrowing protocols. We thought like, okay, we should move away from this model and build our own like immutable permissionless stack, which is what Morpho is today. And so we're like, is it really asset management? It's actually quite different because it's non-custodial. So we decided to call it like non-custodial asset management. And, we coined the term like asset curation, which to our pleasant surprise is now like an industry standard of like everybody's like, it's like the job of like 40 different like companies right now that are being very active in the ecosystem. So that has been incredible. But I generally think that to your point, this is just the beginning and obviously there's so much more types of risks to underwrite and to price in the world that go way beyond crypto. And I think the only way to get there if we want to move beyond speculation powered like lending use cases, it's obvious that we're going to need a very active and a very serious like ecosystem of vault managers and curators to be able to like fund and finance the entire world and all the needs that we have way beyond crypto-backed loan financing.
So just to kind of add my color to that, it seems like, at the simplest level, we've moved from a more DAO-managed, vertically integrated approach to this kind of open marketplace approach. I'd love to understand, James, from you, like, what are the trade-offs? What do you get with each? Obviously, there are benefits and costs to each. I'd love if you could unpack that a little bit.
From the DAO?
Yeah, from the DAO vertically integrated kind of approach to the more marketplace approach.
So just to add some other background, I think tokenization to me was phase one. It was that meme with the stick where it's like do something. And Vaults has made this now the business model on chain. This is really like, to me, you can have the risk, the limits, everything can be in a smart contract. Because in tokenization, everything was still running on Web 2. Now this brings everything into Web 3. In terms of the DAOs, I see this as being potentially a governance nightmare if you want something spicy, and being very slow. And then you also end up with 3 major players dominating the vault space. So the DAO thing could be good, but it could also be a complete nightmare for vaults, where a lot of the pension funds, a lot of the investment funds all go with the brands that they trust and know, and no one else gets a look in. Whereas that's not, to me, the value of vaults. The value is you can show up with a really innovative product, and then people can start using it straight away. As long as the risks are set and your risk appetite is set. The other option of a market-based one, to me, that can move at an enormous speed. You can fork a vault, add different yields to it as well. So there's so much you can do on a market-based one. And I feel like that's the more competitive version that I would be looking at as well. Because with the competition and everyone can still keep innovating, it means you have to continue to serve your customers. Whereas what happened in old traditional finance was they created this huge moat and the service got worse and the fees got more expensive. And I really want us to avoid that when we're thinking about building out vaults in the future.
Yeah, thank you, James. That was great. Okay, so let's talk a little bit. We're supposed to be talking about the future here, right? First of all, like, what do you see as the biggest difference between now and the future in terms of actually like who's participating in the ecosystems? Like, what is the defining feature? One that comes to my mind is obviously the institutionalization of this, and with that kind of like signpost, what are they looking for, and how does the current models play to what they're looking for, and how does it not meet their needs at present time?
Sure. So I guess, the first, observation of those large institutions is that you have hundreds of billions of stablecoin that are not served with yield. And so the first thing they come about is like, hey, we have all those off-chain products, off-chain funds that we could serve to this distribution of underserved like stablecoins, right? And so this is why tokenization has been such an important thing for those funds and like off-chain like institutions, because they don't have to build new financial products. It's just a distribution mechanism, frankly, where the only part that goes on-chain is just the shares of the fund, which, makes it interesting in terms of accessibility, but in no way is like financial innovation in the sense that's going to improve the quality of the financial product, is going to improve the fees and the liquidity and the integrability of those products, right? So that was like the first observation, is that, okay, they need to serve those products, right? And then they start to realize, hey, when we want those tokenized assets to be integrated into DeFi, well, that does look like a Frankenstein, frankly, because you have to merge two completely, when you think about it purely from like the computer scientist like angle, like you have two completely asynchronous databases. One is like the fully synchronous atomic, like, Ethereum chain. And on the other one, you have your fund, which is running on 10 different ledgers that were built, I quote, before Vitalik was born, right? So, that makes it very, very hard to interpret and build actually like interesting financial product that can function well. And this is where vaults come into play for those players, is that they see the benefits of operating their funds directly on chain and do asset management directly on chain, as opposed to tokenize off-chain old technology and try to bring it on chain just through the shares of the funds being tokenized, right? So yeah.
I think it's a really good point. I think a lot of people realize, a lot of banks, asset managers are using 30 different systems that are sticky taped together. And this really causes huge inefficiencies. And they're still faxing stuff to each other as well, which is another really big issue. And this whole programmable money, I guess, really unlocks a lot of innovation that we haven't even thought about yet. And the thing that's exciting to me about vaults is that it becomes multi-asset plays you can do, and things that aren't possible in the traditional finance world.
Yeah, and I like to think of the difference between like an off-chain fund and a vault, especially if you take the angle of like databases. Like if you look at a fund like in TradFi right now, it's an aggregation of multiple financial products who are tracked, each of them in 10 different databases. And so each database has to know how to communicate with one another. You have to connect the dots for each of them. You have to make the connection secure. You have to reconciliate like the asynchronicity of each. Maybe you need it to be arbitrage, et cetera, et cetera. And it does not work on like 24/7, obviously, et cetera. And so I think of Vaults as like one shared, like benefiting from one shared computer where you can access the whole breadth of financial products that are being built and financing that is being issued directly on Ethereum, and aggregate this into one single atomic entity.
I'd say that Vaults took away the overwhelm that lots of enterprises were feeling about lots of different aspects of work. How does this work? How does this work? And maybe not to shoot Vault Summit down, but Vaults made DeFi boring enough for institutions to come on chain.
So Paul, I know you spend a lot of time working with institutions right now. I would just love to understand better, like behind the curtain, what are the things that are top of mind for them? And then I'd love if you could blend that with this distinction you just made between what I'm calling tokenization, which is a much more skeuomorphic concept, it sounds like, and what you're defining as vaults. Like, so to recap, what do the institutions want, and then how does it fit into the future of vaults as it vis-a-vis tokenization?
Right. So the interesting thing is that all the technical things I just described, no one cares, right? Like if you pitch it to an institution, and I have for a year, no one is interested because they're like, oh, like maybe, but I don't even get it. So like, I'm not able to comprehend what you're talking about anyway. Even though it makes sense, right? Or at least I think it makes sense, right? And I think what really moved the needle for all those institutions is business, right? And distribution, right? So you see all those fintechs that own a ton of distribution that are now starting to think, hey, that would be great if I also own not only my distribution, but also my financial stack, right? And I stop putting all this money into off-chain funds that I have no control over. And what about like actually be a fintech full stack, right? And settle on-chain directly, right? And so, famously, like Coinbase has built Base and is now moving all of their financial products into the chain, starting with like the Morpho loans product, and then with the Morpho earn product that they built both inside the main Coinbase consumer app. But that's Coinbase has been pioneering a move of like getting the tech-enabled financial distribution to move on-chain all their infrastructure. So if you think of like pretty much every single fintech, every single exchange, every single neobank are thinking about moving their financial products on-chain, right? And once you do this move, you're thinking, hey, I want my yield or I want my loans to be able to be offered to my users. And this is where you start thinking, hey, who's going to be managing that, right? Who's going to be risk managing all of those products, right? And this is what creates interest for the large scale like institutions to come on chain, basically.
Any follow up to that, James?
I would say one of the things that we haven't discussed yet, and it's maybe not the most popular thing to discuss, but here I am, is the Vault's backend. I think Robinhood put tokenized stocks on there as an operational compliance play. They can reduce their operational costs by 50, 75%, and it costs just the gas fee to launch more tokens in the future. This is a huge margin of opportunity that they can then increase profits with vaults and programmable smart contracts. And I think that's an underrated thing when you hear people talking about tokenized stocks, and then you look at the why, the actual major benefit is ops and compliance in my mind.
Yeah, I think that's right. I think it starts with like regulatory arbitrage, quote unquote, of being able to like settle all of this on like a single chain. And then as soon as you get the tokenized piece, then you get access to the entire DeFi ecosystem that we've been coding for the last like 8 years, where instantly you have, okay, financing with stock tokens as collateral. Instantly you get yield on your stocks. Instantly you get margin trading on your stocks and all forms of like perpetual and leverage trading without Robinhood having to build a single line of code. It's already there, right?
Can borrow off my uranium.
Yeah, exactly, right. So, there are some caveats to that and the risk you take, but yeah, it's completely possible. So yeah, very excited about that.
Okay, so can you guys help me understand? Let's just fast forward 10 years from now. What does this practically look like? What do vaults practically look like, and how are institutions using them? Like, and how does it compare to right now?
I think it really is going to look a new form of fund as they exist today. I think effectively what it would look like is you take like a Morpho vault, like as you have right now, which is like managed by an asset manager, an asset curator that invests into multiple lending markets. The goal is like, how do we extend this to just beyond like crypto collateralized, variable rate lending to a much bigger breadth of like issuance of loans that goes way beyond what we're doing today. And so what a fund would look like is like essentially an aggregation of native issuance of all types of financing, which at the end of the day is what every single fund is doing in the real world. Like if you take an MMF, like a money market fund, like at the end of the day, it's aggregating loans that are being issued by a state, right? And when you compare the job of this fund manager and the job of a vault manager, well, it's very close in so many different ways. Obviously, there's the term structure, there is liquidity constraints that are different, etc. But over time, the gap will be bridged significantly. So concretely, I think that's, we will be ending up mirroring a lot of the stuff. I think if we can bring some of the uniqueness of the chain, most notably the non-custodial part, I think that'd be great. Like there's so many things so many guarantees that you can provide to an LP, to a fund when you are on chain that you can't when you're off chain. The main thing being the non-custodiality. Like for example, in the Morpho vault, like you can exit at any point in time for the underlyings of your fund, right? And you don't get to trust or rely on the efforts of the asset curator to have the yield generated and to like they can't effectively take custody of your funds, which is a very powerful feature.
James, I'm just curious. It seems, I can tell you from talking with so many companies and my own portfolio companies, that the institutional interest right now in vaults, but just in crypto beyond, is at an all-time high. Stablecoins is the obvious thing you can point to, but stablecoins have been around for a very long time. What do you actually think the reason is for this palpable shift over the last year?
I think a lot of the institutions have realized that they can be way more efficient, they can create way more yield, and this is an opportunity for the financial plumbing to finally change. Going back to I think in 10, 15 years, there'll be no assets, not just money, no assets sat idle. So if you have them in vaults, they're working constantly for you. If you have, I don't know, if I want to own a percentage of a YouTube channel, it might live in a vault and I can buy and take the revenue from that. You can go completely wild with this, and I think they finally see the operational cost benefits, the compliance cost benefits. A lot of talk is privacy is not acceptable, but sometimes actually with companies, I want it to be really transparent. If I've got money in a bank account, I can't see what they're actually doing with it to generate yield, whereas on-chain I can, and I can demand that. And I think they're starting to realize that consumers are wanting this too. We're in Latin America. You've got 120 million people without a bank account. They want that economic activity to come on board, and they see that as on-chain being the fastest way to do that. Because you've probably got 2 billion people on the planet without a bank account still. That's a lot of economic activity that they can hoover up. I know that they're doing it for market share, and that's okay as long as we can keep vaults permissionless and keep that steady. I think we can have a seat at the table in the future too.
Oh, thank you. Okay. I would love to just spicing it up here a little bit. What's your most contrarian prediction about vaults that most of DeFi would disagree with? Let's start with you, Paul.
I think it will make tokenization irrelevant much sooner than we think. Just because once you have a fund that's much more powerful when it's on chain, why do you even bother bringing the off-chain old tech that again was created before Vitalik was born, right? Like it does not make any sense, right? So as soon as you start having financial products that are strictly better, period, like no doubt, compared to the off-chain stuff, like why do you even bother bringing them, right? So I think that would be like a hot take, yeah.
James? Well, first, any reaction to that?
Yeah, I think that I hadn't thought about that, but I think that could be a really interesting take. I mean, tokenization would still be important, but it would die into the back end. It's actually,
I think it's a transition.
What happens to the tokenized product, and vaults is that answer.
Well, certainly for assets that need to be off chain, right? Like well, I guess your whole point is that they're converging. I'm thinking of stocks, but obviously there can be a world where you're issuing stocks natively on chain. There's
I know a region that's doing it.
a lot needs to change, but yes, that's a good
when you
point.
think of like protocols like Morpho, etc., like, you know, obviously the token is different, but you could think of like the network token of Morpho as like a native issuance of like having ownership in a given project, right? So obviously it's very different, but still has comparisons.
Yeah, that's a good point. Sorry, James, I cut you off.
Contrarian take. Humans will not choose their curation vaults. AI agents will transact way more on blockchain than humans ever will. And they'll probably be better at managing our money than we are. And that would be my hot take, because humans don't like losing control.
James, you opened the AI can of worms. So now you have to live with the consequences. Well, I lead our AI investments at Variant, and I have not yet seen. This has been the promise for a very long time, what you just said, but I have not yet seen this at scale. Like, why do you think that is? What's missing right now?
I think the AI agents are still not trusted. They're not ready yet, but the progress of AI is mind-blowing that in 36 months we'll be there.
Interesting. Building trust with agents is a whole nother conversation. Okay. That's about it for my questions. Any final thoughts, guys?
No, I think we're good. Is there any question for the audience or not? Maybe not. No.
Let's turn it over for questions.
You guys have
Nadia here from Lagoon Protocol. James, a pleasure. And on the AI agents and the potential efficiency that these can bring to the markets when they are so super good and sharp at trading and much better at allocating, how do you think those AI-powered agents markets will look like?
It becomes a zero-sum game where everybody goes to the bottom, right? But some people want different strategies. Like, my parents don't want anything risky because they can't earn it back anymore. So you can get AI agents that can have, you know, really low risk profiles, savings profiles. So I think you'll see a ton of different exploration. And then the thing is, I think AI is not there yet with the creativity. I think the amount of innovation and assets we don't even think about trading, and the multi-assets. Vaults has really escalated the multi-asset thesis. If you can't just have one asset on chain and it's useful, you need multiple different ones. And I think, I hope, with uranium going onto Morpho, I really hope you start seeing some really crazy stuff in the future too, and we keep the experimentations alive. But AI agents are going to be interesting, and there will be some trust issues, as Daniel said.
And by the way, on the trust issue, like the way I like to think of AI versus blockchain is really like probabilistic computing versus deterministic computing, and like obviously agents will have a lot more agency and execution capabilities, but whenever it comes to like empowering agents with trust, like blockchain will come with like trustless guarantees and immutable contracts that, you know, can inform guidelines within which like they can behave, obviously. So yeah.
more questions? All right, thank you guys.
Thank you.
Thank you.